Trading platforms. They're marketed as tools for anyone to make money, but let's be real, they're not designed for the average Joe. Today, I'm going to break down why trading platforms might actually be better suited for the wealthy, how they operate, how the brokers and the whole process work, and even how some platforms might be scamming people like you. First off, let's talk about who these platforms are really for. You've probably seen ads saying anyone can trade, become financially free. Sounds great, right? But here's the thing. They're selling a dream that's really only achievable if you have big money to play with. If you're rich, you can afford to lose. You can make risky moves. And if things go wrong, it's just a small dent in your overall wealth. Now, if you're someone trying to make this your main source of income, that's where the problems start. The majority of users on these platforms are not walking away with fat profits. Most of them are bleeding money. Why? Because the system is stacked against the small guy. These platforms encourage high-risk moves, fast trades, and get-rich-quick schemes. The reality? They benefit from your losses. So how do they work? Let's dive into the broker system because this is where it gets really interesting. A trading platform is essentially a broker. Think of the broker as the middleman between you, the trader, and the market itself, whether that's stocks, forex, or cryptocurrencies. But they're not just any middleman. They've got several ways to make money off of you without you even noticing. Here's what happens when you place a trade. You decide to buy or sell an asset, whether it's stocks, forex, or crypto. You hit that buy button. Now, you think your trade goes directly into the market, right? Wrong. First, your order goes to the broker. The broker can either fulfill your order directly from their own inventory or send it to a third-party institution. But here's where they profit. Brokers often use something called payment for order flow. Payment for order flow means brokers like Robinhood or eToro sell your trades to third-party firms known as market makers. These firms execute your trades, but they pay the broker for sending them your orders. So the broker makes money whether your trade wins or loses. What does this mean for you? It means your trades might not be executed at the best possible price. Let's say you're trading at $10 per share. By the time your order reaches the market maker, the price could have shifted, and guess who profits from that difference? The market maker and the broker. This small price difference is called the spread, and that's another way brokers make money off your trades. They make more money the more trades you make, so they're incentivized to get you to trade often, even if it's not in your best interest. And let's not forget about fees. Even those zero-commission platforms are not really free. You might not see a direct commission on your trades, but there are hidden fees embedded in the spread or in the withdrawal process. And if you're using leverage, borrowing money to trade bigger amounts, then interest fees start piling up fast. Leverage can turn a small loss into a big disaster quickly. The reality is that most traders are not aware of these mechanisms. Studies show that over 80% of day traders lose money in the long run. They're caught up in the excitement of fast trades and big returns without realizing that the broker is always profiting, whether you're winning or losing. Here's the entire process laid out. You place a trade. The broker takes that trade and either fulfills it themselves or sends it to a market maker, who pays the broker for the order. The market maker executes the trade at a price that may not be the best for you, but the broker and market maker both make money from the difference. So while you think you're getting the best deal, they're pocketing profits every step of the way. Take apps like Robinhood or eToro, for example. They act as the middleman, encouraging you to buy and sell quickly, all while they profit from payment for order flow. Sound sketchy? It is. Your trades are delayed, manipulated by fractions of a second, and optimized for their profits, not yours. And platforms offering cryptocurrency trading? Same game, different asset. The volatility is higher, and so are the risks. With high volatility assets like crypto, the spreads can be even wider, meaning more money out of your pocket and into theirs. Plus, many of these apps offer margin trading, where you borrow money to trade larger sums. Sounds tempting, right? But margin trading amplifies both your potential gains and your losses. Lose a few trades on margin and you're not just losing your money. You owe the broker money too. But here's the kicker. These platforms are not your friends. They're in it for the profits, and they'll let you bleed money while they make theirs. Sure, they provide the tools, the fancy graphs, the sleek interfaces, but they also thrive on the fact that most of their users don't really understand what's going on behind the scenes. Think about it. If trading platforms were designed to help everyone make money, wouldn't we see more success stories? But no. Instead, they thrive on a constant churn of new users, who eventually lose money and get replaced by more people buying into the dream. So, should you trade? Well, if you're wealthy and can afford to take big losses, maybe. But for the average person, you need to realize this. Trading isn't a guaranteed way to make money, and in most cases, it's designed for you to fail. If this video opened your eyes to the reality of trading platforms, hit that like button and subscribe for more deep dives into financial truths. And hey, if you want a more detailed video on how these platforms are scamming people, make sure this video hits 1,000 likes and I'll make it happen.